Should we take the next trade after having a string of 6 losing trades? Should we not have taken the most recent trade? What is your emotional pain threshold? 2, 3, 5, 10 losing trades in a row? If your setup criteria alerted you to buy FedEx, would you have taken the trade if the last 6 trades in FedEx had been losers over the last 2 years? Most investors would see 6 consecutive losing trades as a big problem and be turned off. Their subconscious mind would default to thinking that they know what will happen next. Self-sabotage thinking like this is one of the main reasons that the majority of people trying to trade the stock market aren't even profitable, let alone outperform mutual funds or the index. In a moment, I'll discuss what they should be thinking. But before that, let's set the scene. In June 2020, COVID was running rampant, and the fear of the unknown filled lockdown communities the world over. Market commentary experts were telling us to stay away from the market until the uncertainty of COVID waned. However, the S&P 500 had risen 34% over 10 weeks after the 34% rout over just 33 days during the COVID market crash in March 2020, including a 5.9% fall on the day that the next signal to buy FedEx occurred, according to the unambiguous rules of the edge that is documented in the investment plan for this real money portfolio. In this chart, you can see that the FedEx share price had had 8 consecutive lost trades over 2 years, where each breakout failed, 6 of which had been traded in this portfolio. The other 2 weren't traded because this portfolio was fully invested in other stocks at the time. The entry signal for the next trade, the one I'm going to take you through, is shown in the bottom right-hand corner. Lots to compute if you're a subjective discretionary trader with an immature trading mindset. 6 consecutive losing trades in FedEx in a long downtrend, COVID running rampant around the world, and a 5.9% fall in the S&P 500 on the day your system calls you to enter a trade in FedEx. Wait until you see what happens. But before then, and talking of losses and wins, I'm reminded of Mark Douglas's third fundamental truth, which tells us that there is a random distribution between wins and losses for any given set of variables that define an edge. Let's talk a bit about the edge that Mark refers to. Its more scientific name is the mathematical expectation or expectancy of your system. I also call it a statistical edge or probabilistic edge. It's an equation calculated by using the win rate and payoff ratio of your trades over a large sample, where the payoff ratio is the average size of your winning trades divided by the average size of your losing trades. The beautiful thing about having a pre-researched edge is that it incorporates your losing trades into your thinking before they happen, as if they'd already happened. This is what thinking in probabilities means, if you've heard that phrase before. If you haven't, then you need to learn about it. Learn lots about it. And you can only think in probabilities if you have an excellent idea, before you place any trade, what the average size of your losses might be and what their relationship is with the average size of your wins. A mathematical expectation or edge with a payoff ratio of 2.5 and a win rate of say 45%, after costs over a large sample, will nicely outperform just about any total return market index, and thereby just about every mutual fund. Yes, with more losing trades than winners. You see, with an edge that has a large enough positive mathematical expectation or edge, losing is winning. For example, the edge or expectancy for FedEx over 61 trades coming into this next trade, which is signaled at the bottom right of the chart, was 0.75, even after 8 consecutive losing trades. Expectancy is calculated from the payoff ratio of 2.3 and the win rate of 52.46%. But that is the edge just for FedEx. It is more necessary to know what your edge is at the portfolio level, trading many simultaneously open positions. But that will have to wait for another YouTube video. The algorithm behind the edge being discussed here is composed of unambiguous technical analysis criteria that determine precisely when to buy and when to sell. This winning algorithm is unique to Sharewell systems. The algorithm was researched over 6 elapsed years by myself up until 2015 and has since been refined by my team and used in live trading the stock market over the past 7.6 years in the 2 open book publicly audited portfolios that you can follow on this YouTube channel. Everybody needs an edge like this to be profitable enough to efficiently beat the market, and hence nearly all mutual funds over the long run. But an edge is not a guarantee, it is a probability. And it is only one of the 3 parts of a trading or investing methodology. The other 2 parts are firstly position sizing or money management, and secondly risk management. More about that in other videos to come. Now let's see what happened with this next FedEx entry signal after those 6 consecutive FedEx losers executed in this portfolio. It turned out to be a winner, a really juicy winner, closing the trade when a mechanical algorithmic exit signal occurred on the 5th of January 2021. No story to be told about all the trading days over this nearly 7-month trade, except that the language of people, being all the geopolitical noise, market opinion, and outside influence, was completely ignored. Until the language of the market, the movement of price, spoke loud and clear to exit, resulting in a locked-in profit of 86.9% after commissions, executing the single 7th trade after the 6 before it. This real money portfolio made double the profit compared to the total loss from the 6 previous losing trades. The best traders are not those that win the most, but those that lose the least. Looking back at all the trades completed in FedEx alone in this real money portfolio, to that point in time, there had been more profit trades than loss trades. Some of the profit trades could have been turned into losers had there been no exit signals to adhere to. And the loss trades could have been even bigger had there been no exit signals to be alerted to. Hopefully for you, the lesson learned here is that you must work out a way to cut your losses and let your profits run, and not just give that principle lip service or dismiss it as a cliche. Small losses come from lessons learned. Large losses come from lessons ignored. Over the months and years to come, we'll keep publishing here on YouTube, learning like this from real-life trading experiences with using our unique mechanical algorithm. To stay connected, please subscribe and click the bell. Until next time, when I look forward to showing you through this real money portfolio again, I wish you consistent and objective investing.